Ethereum is just Wall Street in disguise. Imagine for a moment that you're being told, this isn't about technology or innovation. This is about the same financial system we thought we escaped, just wearing a digital mask. What if Ethereum isn't revolution at all, but simply Wall Street in disguise? Stay with me, because what you're about to learn isn't speculation. It's the hidden underside of Ethereum's staking, MEV, and roadmap. The things that look revolutionary on the surface might actually reveal a quiet return to financial centralization. We've been sold a vision, Ethereum as the global computer, open, fair, and decentralized. But beneath the sleek branding and community spirit lies a roadmap that reads more like corporate planning than grassroots evolution. And that's where things get interesting. Ethereum's roadmap sounds epic. The merge, the surge, the scourge, the verge, the purge, the splurge. Names that promise scalability, fairness, and progress. But each step, while framed as technical advancement, quietly embeds mechanisms that consolidate power and profit. Take the merge. The shift from proof of work to proof of stake. Instead of miners, Ethereum now relies on validators who must stake 32 ETH, over $100,000. For most people, that's impossible, forcing them to join staking pools. And that's where control starts to concentrate. These massive staking pools act like digital banks. They collect deposits, run validators, and distribute small yields back to you, while keeping the best part for themselves. The bigger the pool grows, the more blocks they propose, and the more rewards they keep. That's exactly how traditional finance works. Capital attracts capital. Scale amplifies power. And soon, the same pattern emerges. A few large operators dominate the network while smaller participants just follow along, convinced they're part of a fair, decentralized revolution. Now, enter the next phase. The surge. Supposedly about scaling and roll-ups, but also about enabling infrastructure giants to capture even more value. Every improvement creates new layers of complexity where those with resources gain inside advantages over everyone else. Combine that roadmap with staking and something called MEV, maximal extractable value. And suddenly, Ethereum's decentralized dream starts to look eerily like the inner workings of Wall Street itself. And that's where the story gets truly revealing. Let's talk about staking first. It's marketed as easy passive income. Lock up your ETH, help the network, earn yield. But when you stake through a big provider, you surrender control. They validate, they profit, and you just get a fraction of the pie. It's a soft form of control, subtle, invisible. Your ETH is technically yours, but operationally, it's theirs. They decide how blocks are produced, which transactions get processed first, and which opportunities to extract MEV. It's ownership without control, just like banks. The larger these staking entities grow, the more frequently they're chosen to validate blocks. The more blocks they control, the more rewards they earn. And the more rewards they earn, the more users stake with them. A self-reinforcing loop of power. Pure finance. Now, let's peel back the real layer. MEV, short for maximal extractable value. This is where validators reorder, insert, or exclude transactions inside blocks to profit. It's like front-running, sandwiching, and exploiting order flow, all wrapped in the label of innovation. In simple terms, MEV means insiders can see your pending transaction before it's confirmed. They can buy before you do, sell right after, and take the profit difference, while you pay higher fees or worse prices. Sound familiar? It's digital insider trading. Searchers, builders, and validators all participate in this hidden economy. Validators control which transactions enter the block, builders design block bundles for maximum profit, and searchers find opportunities to exploit them. Together, they siphon value invisibly from regular users. So while you're staking for a few percent a year, the big players are making multiples through MEV extraction. It's not just technical advantage, it's structural privilege, a hidden layer of revenue the public barely understands, yet funds the powerful few. In traditional finance, it's called order flow. High-frequency traders and hedge funds buy privileged access to see trades early, front-run them, and profit. On Ethereum, it's rebranded as MEV. Same playbook, different name. And that's why the parallels are too perfect to ignore. Ethereum's roadmap continues with names like the Scourge, the Verge, and the Purge, each promising to solve the problems of centralization. Yet every update introduces new intermediaries, new layers, new opportunities for insiders to optimize returns at everyone else's expense. The more ETH you stake, the more power you have. The more power you have, the more MEV you extract. The more MEV you extract, the more ETH you gain. It's exponential advantage, a self-feeding cycle where the rich literally get richer by design. Let's map this to Wall Street. In legacy finance, banks control liquidity. Hedge funds exploit milliseconds of advantage. And retail traders? They provide the volume that insiders feed on. Ethereum's validators and builders are the blockchain's equivalent, running the same play. This is why Ethereum's decentralization narrative can be misleading. The tech is real. The code is brilliant. But the power structure forming around it mirrors the same forces we see in legacy finance: capital, access, infrastructure, and insider positioning. You might think, but Ethereum is open to everyone. And that's true, in theory. But in practice, access to MEV infrastructure, capital to stake, and bandwidth to run validators are all concentrated. Open code doesn't equal open opportunity. Even the names of upgrades sound like freedom. The Surge, the Verge, the Purge. But every one of them ultimately rewards scale. Efficiency becomes the justification for consolidation. And before you know it, decentralization becomes a comforting illusion. MEV isn't going away. In fact, Ethereum developers are institutionalizing it, making it a legitimate, permanent part of how the network functions. That means the hidden advantage for insiders isn't shrinking. It's being codified into the protocol itself. If that sounds like the birth of a blockchain Wall Street, that's because it is. Ethereum didn't eliminate the old system. It digitized it. It replaced stockbrokers with validators, traders with searchers, and banks with staking pools. Same mechanics, new skin. So why should you care? Because your yield, your stake, and your belief in decentralization all depend on who truly controls the system. You might think you're part of a peer-to-peer network, but in reality, you're lending power to modern digital intermediaries. Every block, every upgrade, every staking pool pushes Ethereum closer to a model where infrastructure owners dominate. The people who own the validators and the MEV pipelines will control the economics, and everyone else becomes a passive investor. In traditional finance, people complain about the 1%. In Ethereum, it's not much different, except the concentration is measured in validator nodes and MEV revenue instead of dollars. The same pyramid, built from new materials. So ask yourself, if the same incentives produce the same power structures, was the revolution real? Or did we just rebuild the same empire on-chain, transparent in code, but opaque in control? That's the uncomfortable truth few dare to speak. Ethereum's brilliance is undeniable. Smart contracts, decentralized apps, DeFi, they changed the game. But the deeper you look, the clearer it becomes. Power gravitates upward. The same gravitational force that built Wall Street is now pulling inside Ethereum's core. If you stake your ETH, learn who you're staking with. Do they run MEV Boost? Do they share revenue? Or are you just another source of liquidity feeding their yield machine? Awareness is your only protection in a system that profits from your blindness. Decentralisation isn't guaranteed by technology, it's guaranteed by behaviour, by thousands of individuals choosing independence over convenience. But convenience always wins first. That's why history repeats itself, even on the blockchain. Ethereum didn't fail. It succeeded so well that it attracted the very institutions it wanted to replace. And once they arrived, they began shaping it in their own image. Slowly, quietly, elegantly, the decentralized dream, becoming Wall Street's digital twin. The roadmap keeps evolving. New names, new layers, new hope. But remember this, technology doesn't eliminate power. It only moves it. And where it moves depends on who understands the game first. In Ethereum, that's not you. Not yet. So before you click stake, before you buy into the next upgrade, ask yourself, who benefits from this system staying exactly as it is? Who owns the validators? Who builds the blocks? Who profits when you think you're earning passive yield? Because once you see it, truly see it, you can't unsee it. Ethereum's elegant design hides a financial machine that mirrors Wall Street's deepest flaws. It's efficient, profitable, unstoppable, and quietly centralized. So yes, Ethereum changed finance forever. But not because it freed us, because it showed how easily freedom can be packaged, tokenized, and sold back to us under the banner of decentralization. The revolution got corporate, and no one noticed. If this opened your eyes, share it, subscribe, and remember, the more you understand how money and power move beneath the surface, the less likely you are to be used by the system pretending to empower you. Because in this game, knowledge isn't just power, it's survival.